What's up, guys? John here. The biggest banks in the United States just reported massive losses in the billions.
Citi is reporting a net loss of $1.8 billion.
But the reason for these losses is what every American needs to pay attention to, because this is about to rewrite American history. Citigroup just reported a $1.8 billion loss for the fourth quarter of 2023. Bank of America just reported a $3.7 billion loss. And why? Well, they have to put money. All the big banks have to put money in something called this new government deposit insurance fund to prevent future bank failures. Now, some people might say this is a really good thing. We need stability in the banking system. But what is happening behind the scenes, behind the curtain, is what you need to pay attention to, because this is going to impact every man, woman, and child, every American citizen, every household, every business owner, employer, and employee in the following year. Coming July 1st, 2025, all of this will completely go into effect. But every single month, we're moving closer and closer to this deadline, and the banks are preparing for this. I'm going to show you exactly what's going on and what you should do to position yourself for this. Please hit the like button, hit the like button. YouTube will share the content, educate more people about what's going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. I believe the next 18 months are going to be extremely important. So if you are a business owner, you're a real estate investor, you plan to be, you're going to need access to credit. The better your credit score, the easier it's going to be for you to get access to a good interest rate loan, be able to borrow more, and have more options. So if you have any credit issues at all, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session for Monday. Take a look at this. So Citigroup, cutting 10% of its workforce. They estimate that number closer to 20,000 employees. You know, they say that they have roughly 200,000 workers. I've seen estimates as high as 280, 290,000 workers. So yeah, 200 or 20,000 workers out of the 200,000 that they're reporting here. So 10% of their entire workforce axed as of today, January 2nd, right? Citigroup, again, Bloomberg, 20,000 roles. They're looking to, basically save $1 billion. But look at this. What is happening is so huge. The third largest U.S. bank, Citigroup, reported a $1.8 billion loss for the fourth quarter on charges related to refiling a government deposit insurance fund and other one-off costs, right? 96,000 views, came out about an hour and a half ago. Now, Bank of America, talking $3.7 billion in charges. $3.7 billion. And why? This fourth quarter profit shrank as the lender took a $3.7 billion in combined charges to refill a government deposit insurance fund and phase out a loan index. Now, they go on to say that some of these losses are due to shrinking deposits, consumers have less money, they're issuing less loans, and everything is just kind of contracting. As you would assume, high interest rates right now on homes and cars, people are getting less excited to go out there and borrow money, and banks are getting cautious about who they're lending money to. So when you look at this, it's fascinating. They say that this Bank of America shares fell after the company reported lower fourth quarter profit hit by regulatory charge. This regulatory charge is such a big story that's getting almost no attention. And it should be, because it's about to change everyone's life. As rates have continued to rise in 2023, we are seeing significant declines in consumer deposits. The main driver, total deposits decline, is shrinking checking balances. Well, why? Record high inflation, record high cost of living. People are more dependent on credit cards than ever. And because of this, they're paying these record high interest rates on these credit cards. Just making the minimum payments is shrinking their checking accounts, right? It's shrinking their savings accounts. It's shrinking their ability to save and get ahead. Now, here's what they say. Bank earnings look really bad this quarter. Here's why. And they go on to say, blame the regional banking crisis. This regional banking crisis, Silicon Valley Bank, all those banks that have fallen, that is going to be the excuse to completely change everything to protect us all, right? Look at this. This new FDIC rule came out, November 16th, about 2 months ago, not even 2 months ago. Under the final rule, the FDIC will collect a special assessment on an annual rate of 13.4 basis points beginning the first quarter assessment period of June of 2024, i.e. January 1st through March 31st, 2024, with an invoice payment due on June 28th, 2024, and will continue to collect special assessments. Now, here's how this works. Bank earnings look really bad this quarter. Here's why. New York, JPMorgan Chase kicked off earnings season Friday with a big miss, but that's because of a strange accounting. The bank's fourth quarter profit fell 15% from a year before to $9.3 billion, way less than analysts surveyed by FactSet had expected. Earnings per share came at $3.04, as well under the 3.35 estimated by FactSet. Those numbers might imply the bank is struggling, but that's far from true. JP Morgan just notched the most profitable year on record. Revenue grew 23% to $158 billion in 2023. Profit grew by 32% for the year to $49 billion. So what explains the discrepancy? Blame the regional banking crisis. So if the biggest bank in America, right, JP Morgan Chase, is now showing that they're suffering, imagine what this is going to mean for local credit unions, small banks, these other mom and pop banking institutions. It's going to mean that there's going to be more pressure, more weight on these banking institutions. And what's going to happen as more and more and more of them struggle, some of these go under publicly, more funds will flow to the big banks. All right, and these big banks are going to start acquiring more and more and more of these small banking shops. It cost the Federal Deposit Insurance Fund $23 billion to clean up the mess that Silicon Valley Bank and Signature Bank left in the wake of the collapse last spring. It was a large bank that mostly footed the bill. JP Morgan Chase was dragged by lower one-time $2.9 billion charge to pay related to this crisis. Without the one-time payment, JP Morgan Chase earnings would have come in closer to almost $4 a share, right? JP Morgan Chase, the largest U.S. bank by assets, is often viewed the bellwether for the rest of Wall Street, and other banks certainly experienced similar problems. Bank of America paid $2.1 billion in FDIC fee for the crisis. The bank reported fourth quarter earnings of 35 cents per share, missing FactSet estimates of 53 cents per share. The bank said without that one-time fee, earnings for the quarter would have been about 70 cents per share. Citigroup, $1.7 billion fee. Right? Like all these big banks are issuing all of these fees. And so why? Well, here is what this looks like for this big deadline that's coming July 1st, 2025. And they're going to continue paying into this. So the new endgame bank rules promise greater financial stability, lower returns. Right? Lower returns because there's going to be less lending. Right? So they're going to have less money coming in from profiting from their loans, right? So, but the big corporations, they have so much money. They have so many investors. They have so much flexibility to where they're not dependent on these big banks. It's the small business owner that's dependent on banks. So they say the banking sector is bracing for a major set of regulations prompted by the 2007-2008 financial crisis, but which has origins extending as far back as the termination of the gold standard and the introduction of freely floating international currencies. Bank regulators around the world are poised to finalize the third Basel, according to the international set of bank capital rules born at the summit that began in 1974. Like experts say the new regulations known as Basel III Endgame are still necessary and will help stabilize international financial system that will be prone to periodic collapse. So now what this means for everyday Americans is this. They say that the disputed effects of higher capital requirements, because now banks are going to be forced to have a lot more capital on hand to be able to pivot, move around the hard times. And because of that, they can't lend as much money. So they say bankers say that having to keep more capital on their books means they will decrease lending to households and small businesses or increase interest rates on their loans. So you think about it. Small businesses are already having a harder time competing with corporations, especially since the last few years. As more people spend more time on their devices, they make more purchases online. They're doing transactions less face to face, right? So what does this mean? A lot more attention is flowing to corporations. Corporations have access to cheaper capital. They already have market share. I mean, it's going to be bad news for small business if small business is going to be borrowing money at 12 or 14 or 15% interest rate and they're struggling to be able to attract customers. What's going to happen? If we step into an affordability crisis like what we're in right now, record high inflation, people generally, Americans love to support small business more so than anything. But at the end of the day, it comes down to affordability. If something is on Amazon for $50 and you go to a small mom and pop business and the cheapest they can get it to you, is $100 or $80, who are you going to spend from, right? You're going to spend your money online. You're going to save the $30 or the $50 because that's going to go, a long way for a lot of Americans, right? So when they bring in these capital requirements, what we're walking into is the essential businesses, right? The big businesses, and the non-essential, which is going to be the small businesses that are going to be borrowing money if they can get it. at record high interest rates. That's why the next 18 months, when I've been talking about this on this channel, saying that we're in the greatest transfer of assets in American history, the greatest wealth transfer ever. Because as this situation continues to worsen and capital gets harder to come by and inflation likely gets worse, people are going to be forced to sell. People are going to be forced to free up some expenses, right? Whether it be car payments, second homes, or primary residences, they're going to try to downsize to get to a place to where they can survive. And so he or she who has access to capital, who has a really good job, a really good business, that has the ability to go out there and buy assets, is going to be the real winner, right? That's what's going to happen. Next 18 months are going to be more important than any other time before. So look, when capital requirements are set excessively high, it makes it much harder to secure a loan or credit. This is especially true for working families and small businesses. The Bank Policy Institute, a trade group for the banking industry, says on its website, if they go too far in terms of burdening U.S. banks with regulations, it is absolutely going to negatively impact a special subset of people that rely on those institutions not only for business loans, but personal loans, agricultural loans, that type of thing. Financial Services Director Dana Tumley of consultant West Monroe told The Hill, but some researchers say otherwise. One frequently cited paper from 2009 found that there would likely be a relatively small change in loan volumes in the U.S. banks as a result of higher capital requirements on loans retained by U.S. bank balance sheet. Even if banks restructure their balance sheet to optimize returns on stocks, such moves appear unlikely to be large enough, even in the aggregate, to significantly discourage customers from borrowing or move them to other credit suppliers in a major way. I mean, I'll leave you to determine your belief. What do you think? If big banks have to put themselves in a position to have much higher capital requirements, they're already seeing more defaults. What is this going to mean? They're seeing more defaults on commercial real estate loans, on multifamily real estate loans, on auto loans. What are they going to do? They're going to be careful on whom they lend money to, and they're going to be lending it at a much higher interest rate. That's what I believe. I believe that lending is going to contract in a very, very, very big way. And as that happens, some people are going to really benefit from this and some people are not. What do you think about this? Do you think we're welcoming the greatest wealth transfer in American history and what's happening right now with banks is just the beginning? Drop below. Let's have a conversation about it. If you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session. Catch you in the next one.